Well,
Estimate Arthurou forecast dividend capacity for normal year.
so it was a simple dividend capacity question. And guys, remember, dividend capacity is nothing. It is just like the free cash flows to equity. You have to compute the free cash flows to equity of a business. But keeping in mind, there will be some adjustments like if the parent company is having some subsidiaries. So the remittances will be there. Additional taxation adjustments can be there. Okay. So this you should keep in mind that what the examiner is saying to you. So you know that the free cash flows formula that starts with what is the free cash flows, guys? The free cash flow starts with the operating profit, PBIT.
PBIT.
What the examiner said in this question, PBIT will be how much? Please take participation, guys. PBIT will be 20% of the sales revenue. But the sales revenue was given in this question, how much?
520.
520, and examiner said it should increase by 4%. So how much is the revised sale revenue? 540.8.
541. Yes, 541.8.
So as we have to take the 20%, so 540.8 into 0.20. So what is your answer coming?
108.16.
10,
8.16.
or we can say 108160 if we take 1000 common.
Yes.
Now as equity, so PBIT less interest. What was the loan amount which was there in this question, guys? What was that? 135 million was given,
Yes.
and upon that loan,
8% birth.
8% you are paying. So how much is the interest? 10.8.
Yes, 10.8.
So PBIT less tax, then what is the balance?
PBIT less 108.160 less 97360. 360.
97360. What was the rate of tax? 30%.
30%.
So how much is the tax, guys?
29208.
29208.
208.
This was the profit before tax. This is the tax. So what is the, we can see now what other adjustments we have to pass. So PBIT less interest, less tax. Now add depreciation. What was the depreciation which was given in this question, guys? What was?
30 million.
This has been previously deducted from here. We will add back. How much? 30,000. Now, there was a profit on disposal which was given in this question. How much was that, guys? The profit of disposal is also have been added in this profit before interest and tax. You will
5.9 million.
less it. less profit on
Disposal. 5,900.
5,900.
Yeah.
Up to this point, the question looked very easy because there is no such ambiguities. Am I saying right? The question was quite straightforward, but there was a capex. There was a capex. Now, see, guys, we have to show a working to the examiner that try to understand now. How much cash we are receiving. See, we have disposed of one asset. There was a disposal of asset. When you did disposal of asset, guys, what was the cash on disposal? What was that?
35 million.
Not 35 million. That was the cost. I am saying for how much you have disposed.
Accumulated depreciation is 24.6.
Oh, sorry, not cash. Profit on disposal.
5.9.
How
It's
much was? Profit on disposal was
5.9. 5,900.
5,900. Now, the asset which you have sold, what was the cost of that asset, guys?
35 million.
So 35,000 was the cost.
Yes.
So what was the depreciation of that asset?
Cumulated depreciation was 24.6.
So
600.
24,600. So guys, can you tell me how much cash you have received? It is a simple entry that this was the asset carrying value. And
And
we said
800.
that we have made a profit on this. So what will be the cash which you are receiving?
16,700.
16,700 or 16,300?
I'm getting 16,700. Let me compute again.
5,900 plus 35,000 minus 24,600. How much?
16,300.
This is the cash receipt. How much? 16,300.
16,300.
This
Yes.
is the working one.
16,300.
Now, guys, examiner told you that for the investment in the non-current assets, mean the capex, that was also a very good calculation which the examiner tested in this question. Anyone who can tell me that how you people are going to figure out the capex in this question? Anyone? Tell me, guys. Investment in non-current assets. Tell. Can anyone reply, guys? Please try.
The net value of net asset at the year end is most recent.
Okay. There was
4%.
examiner has told you that net book value at the end of the asset was how much in the recent year?
110.
In the recent year, how much was?
110 million.
110.
10 million. Yes.
This was the net book value of the asset. How much was the depreciation in the normal year?
30 million.
How much was? 30
30
million.
million.
So
Yes.
110,000 minus 30,000. Okay.
Yes.
Then, so the asset which we have disposed, guys, can you tell me what was the net book value of the asset disposed? Tell.
Yes. 10,400.
10,400.
Yes.
And how this balance is coming? Tell me.
35 minus 24.6.
35,000 minus
Minus
24,600.
600.
This is the
Yes.
NBV of
Asset sold.
disposed assets. So, what is the balance coming? 110,000 minus 30,000 minus 104,000. How much?
1 second. 10 minus 30,000 minus 10,000.
69,
It's 69,600.
69600. But examiner in this question mentioned a thing. Examiner said that required level of the non-current assets will increase by 4% from their current level. So the current level was how much? 110,000. What
110,000.
was the revised level? 110,000
Yes.
into
1.04.
1.04. So what is the revised level?
114.4.
114.4.
400.
So this is the revised level. This is the previous level. What is the change?
44800.
This is your capex. See, what is happening? This is only about the double entries. What the examiner is saying, examiner said you have to find the non-current asset figure, the capex figure. This net book value of the assets was there. This was their depreciation, but one asset we have already disposed of. So we are finding out that figure that is present in our balance sheet. That is 69600. But examiner mentioned in this question that the revised level of the NP net book value that should be 4% higher than this one. So this is the revised level. This is the previous level. What is the change? That is the capex. So how much is the capex?
44800.
Good adjustment.
Yes, sir. Very good.
Now, in the same way, in this question, examiner asks you investment in working capital. What was stated for the working capital?
$0.15 investment for every $1 increase in the sale revenue.
So our previous sale revenue was how much?
520.
520. Now it is coming how
Yeah.
much? 540. Okay.
Yeah, 540.8
So how much is the
minus
difference?
520.
540.8
20.8.
minus 520. whatever this is coming, you will be multiplying with how much?
0.15.
So how much is the working capital coming?
3.12. If
So
I
this will
take the
be 3120. Okay.
3120, yeah.
These are the cash flows from your domestic operations. These are the cash flows from domestic operations. But whether in this question, guys, there was any subsidiary company? Tell.
Yes, there was a subsidiary company.
There was a subsidiary company. That name was B company. Okay. The
But
subsidiary company was the B company. Now, examiner in this question has told you that the B company profit before tax. How much was that?
profit before tax of
45,000.
company.
45 million. Yes.
Yes.
Okay. Now, what was the tax of this company? 20%.
20%. Yes.
So this will be 9,000. Your profit after tax is 36,000.
Yes.
Examiner said, whatever the subsidiary company will be having in the profit after tax, first subsidiary will be paying 5% withholding tax. This was there? Tell me, guys.
Yes.
So how much is a 5% withholding tax? 36,000 into 5%?
1800.
1800 is the withholding tax. What is the balancing figure? What is your profit after tax revised?
34200.
34200. And now
Yes.
examiner mentioned in this question that whatever your final PAT figure is, 60% this company will be paying as a dividend capacity as to the remittance for this company to the parent company. So how much remittance?
60%.
60%. How much this is coming?
20520.
20520.
520.
So this remittance you will show here. This is the remittance. How much? 20520. Okay. Now, guys, remember, I am going to explain you people that when there are the adjustments for the additional taxation. Guys, remember, whenever your home country tax is higher and the foreign country tax is lower. Like in this question, our home country tax was how much? 30%. And the other was 20%. This is how much? 30%. This is how much? 20%.
20%.
Whenever your home country taxation is higher, then you have to compute the additional
Additional tax.
taxation. And remember, additional tax is how much?
10%.
10%. But this 10% will be applicable on
Full
foreign
profit.
currency or the foreign country taxable profits. So what are the foreign country taxable profits?
45,000.
45,000.
Yes.
Multiply by 10%.
10%.
It is
4,500.
4,500.
Yes.
This you will show here as additional tax 4,500. What is the dividend capacity coming?
76652.
Good question, guys.
Yes, sir.
This is the dividend capacity. Okay. Good question.
Yes.
Now, Umair, what was the second part?
Let me see. 1 second. Estimate the level of dividend required from B company to give Arthorou sufficient dividend capacity to maintain its dividend level of 0.74 per equity share.
Okay. Now, see now what is going to happen. In this question, basically, whether it has been told that how much dividend you are paying every year. Tell me, guys. Look in the question.
60%.
How much?
60%.
No. 60%. That is the remittance which the domestic company is paying to the parent company, the subsidiary company. I am asking the Arthorou company is paying to its shareholders how much dividend?
Yes. At least maintain the dividend 0.74 per share. It had to promise, the board felt it had to promise for the foreseeable future, it at least maintain the dividend to 0.74 per share, which it paid for
0.74 per share.
Yes,
So how many number of shares are there for this company?
2 million equity shares.
2 million?
No, 90 million. 90 million $2 equity share.
90
Par
million,
value is
$2 equity. Par value is 2?
Yeah.
Okay.
Yes.
So 90 divided by 2, how many number of shares?
45.
45 multiplied by 0.74. How much is the answer?
33.3.
There is something wrong. Let me see the question. Hold on. Because we have to first calculate for the second part, the dividend capacity required. What we have to do? Dividend capacity
Quiet.
required. So anyone who can tell me how we will be having that?
We will take into account rights issue. Like we will add into shares, rights issue, and we will multiply by the
In this question, whether there was any right issue?
yeah,
How much was that?
1/3.
How much?
1/3. 1/4.
1 for 3 right issue.
143 right issue. So what are the existing number of shares?
9.
50?
45.
45. So 45
Yes.
into 1 divided by 3. What are the new number of shares?
15.
Just give me 1 second, guys. Let me look at the question. Written in this question that 90 million are the shares. Okay. And we are doing right issue. How much? 1 4
1 3.
3. So,
Yes.
but this right issue was done. It was stated in the question. State the line. Go through that paragraph, Zenith, for the right issue. What was the paragraph? Please go through that.
Okay. Until 3 months ago, Arthorou company had 90 million $2 equity shares in issue and $135 million 8% bonds. 3 months ago, it made a 143 rights issue.
Okay, then
A number of shareholders did not take up their rights but sold them on. So there have been changes in its shareholder base.
okay, go on.
Some shareholders expressed concern about dilution of their dividend income as a result of the rights issue.
Go on.
Therefore, Arthurou company's board felt it had to promise for the foreseeable future at least to maintain the dividend of $0.74 per equity share, which it paid for the 2 years before the rights issue.
It has to pay for the 2 years before the right issue. Okay. So
Which it
this
paid
was
for 2 years.
multiplied by the 2. So now what are the number of shares coming?
30. So it is saying which it paid for 2 years before the right issue. So I mean, it was actually paid before this right issue. Previously, company paid 0.74.
0.74. See, basically what was happening, 0.74 was given as per share.
Yes.
We have to find the number of shares. Okay. So 90 multiply by 2 into 2. Why we are having this 2 into 2, guys? Anyone who can tell me? This was the point in this calculation of the dividend capacity.
Maybe it's the price of equity share.
The $2 was the, what was that? The face value, or what was that? Par value?
Yes, par value.
And why we are having the multiplication for the 2?
For 2 years.
For 2 years. So now tell me, what are the revised number of shares?
120.
So 120 into 0.74 per share. How much was dividend capacity required?
88.8.
88.8 million. And what our dividend capacity is coming? How much? 76.652.
76.6.
This was required. And our answer is coming how much? 76.652.
76.6.
So how much is the balance?
12.15.
So now it's mean that this 12.15 from where we are getting, we will say to our subsidiary that we are in the need of this. So this should be taken from where? From the remittance. So what was our previous remittance, guys? What was our previous remittance? How much was remittance?
20520.
20520.
520. Yes.
So 20520 we can take is 20.52. Now we are saying our subsidiary to this as well. How much?
12.15.
12.15. So how much total remittance we are requiring from our subsidiary?
32.67.
30.
2.67.
But now remember, again one point. Upon this remittance require, again on this remittance we have to pay the 5% holding tax. Remember? Whenever the
Yes.
subsidiaries has to submit you the remittance, they have to deduct the 5% with the holding. So you will take this value 95. So how much they will remit?
11.54. 95% of 12.15.
Oh, sorry. This was, see, we did the wrong. How we did the wrong? See, the 95% not. The remittance is this. Okay. On the remittance, we have to take 5%. Withholding tax was there. So you will
Yes.
divide this, mean gross up. You will add up this figure 20.52 plus 12.5, 1 point. How much is the figure coming?
32.67.
32 point.
67.
But as the 5% was the withholding tax, this is the 95% figure. So divide by 95, multiply by 100. How much is the gross amount coming?
34.39.
34.39.
Yeah.
Now, this remittance is required from the subsidiary. So, if you want, like in the previous, the examiner said that remittance will be 60%. So, now if you want to find out again that how much that will be. So, see now, you know the remittance we are taking for the profit after tax figure. That is 36. Now we have
Yes.
said after grossing up, because this is how much figure? 95%. Do you remember?
Yes. Yes.
So what will happen now? If you want in the percentage figure, so you can find 34.39 divided by our original amount. That was 36 multiplied by 100. How much is the answer come?
95.52.
It's
53.
mean that we will say our subsidiary that instead of paying us the 60% as remittance, how much they should pay? 95.52%,
95%.
almost 96%.
96%.
Okay.
Yeah.
So this is actually a reverse calculation by which the examiner was requiring from you people that how you people will be able to find that how much remittance will be required that you are having this 0.74 per share. Understand?
Yes.
Now, the other part of the question, which was the theory.
The Arthorou company has decided to increase its level of dividend from B company if its dividend capacity is insufficient. Requirement was, from Arthorou company's viewpoint, discuss the financial benefit of and problem with the decision, and discuss the agency problem and how they might be resolved with the decision.
See now, can you see the sheet, guys? The examiner answer.
Yes, sir. No, it's
No.
whiteboard.
Okay, now see, this is the question which we have solved 76.652, and this was the workings which we have done. This was the 95%. Now examiner was asking in the B part, what are the benefits of this policy? See, examiner is saying the change of policy appears to be viable. Ortho company would have some slack if it had not undertaken the right issue. The new policy takes up the slacks and effectively top up the amount required with an increase in dividend. Because what is happening, guys? You have to increase the dividends. The new policy ensures that A company will have sufficient funds to pay the required level of dividend and fulfill its own investments requirement. It will mean that B company has less retained funds available because previously the company was remitting 60%, and under the revised policy they have to submit 96% almost. But what is happening? They should have less retained funds available for investments, but A company investment opportunities may be more profitable. These are the benefits for the Arthurou company. But what is the problem? Arthurou company is now close to taking all B company post-tax earnings as dividend. 96% you are taking. So what will happen? Only a limited fall in B company earnings would be needed for its dividend not to be enough to sustain Arthorou's dividend level. So what the examiner is saying, only a limited fall in the earnings would be needed for its dividend not to be enough. Because you know what is happening, the 96% remittance is going to there in the question. The 96% remittance the B company is paying to the Arthurou company. So that is the huge level. So if these remittances are being reduces from 96%, for example, they are coming to the 90. So it will be a problematic thing for the parent company. Okay. So, but a fall could easily happen given highly competitive environment in which B company operates. If Arthurou company wants to increase its dividend over time, it could not do so by receiving extra dividends from B company. So the best approach is that instead of you people are saying that the 96% you are having from the subsidiary, that is not a best approach, because if the subsidiary profit after tax were reduced because the competition is there are uncertainties there. So then the parent company will be in the trouble. So as mentioned, an increase in dividend will leave B company management with less retained earnings to invest. So the amount of investment they can undertake with the reduced funds available may be insufficient to sustain earning levels and hence the dividends for Arthurou company. So now see that whatever they are earning, they are 90% paying to their parent company. So that is also giving a demotivation to the managers in the subsidiary company. At least they should have something for the investments. But here the case is the opposite. All the investments are being given to the parent company. Now, the tax regime between two countries mean that the group will suffer more tax. The amount of additional tax payable by Arthurou company on B profits will remain unchanged, but the increase in dividend will mean an increase in withholding tax. Yes. Because now, as the Arthurou company is demanding that the dividend capacity should be this, so that's why what they are saying. Previously, what was happening, guys? See, this company was paying how much? What was there? Which we just studied. This company was having the profit after tax 36,000. And upon that, the 5% withholding tax was there. Now we are demanding from them that our profit after tax, that should be how much? How much, guys? As we said, the remittance should be this one, 32.67, and then it is going to be 34.39. Again, we are going to have, means that we will be paying, this was a 95% amount because the 5% is being deducted as a withholding tax. We grossed up. We said that before grossed up, this is the 100% amount. This is the profit after tax. So our profit after tax for the subsidiary point of view, they will also decreasing. But what is happening, guys? Subsidiaries are giving you the 96% of their profit after tax. That is a very demotivating thing for them. And again, whatever their profit after tax are, they have still to suffer the 5% with the holding tax on it as well before they are remitting this as a dividend to you. Before the remittance, they have to bear the withholding tax as well. That is a very problematic thing at their side. Now, agency problems and agency situation arise between Arthurou company board, mean the principal and the agent, which is the subsidiary company. The proposals are likely to involve agency cost. The policy limits the discretion of B company management by restricting the amount of retained funds available. However, This seems an inefficient way of exercising closer control with agency cost, including the increased liability for withholding tax. If Ortho Company Board has concern about B Company management, it would be better to make changes in the management team. Even if Arthorou Boards has confidence in B Company management, it may nevertheless wish to oversee B companies more closely. Given the dependence of its dividend capacity on the amount of received from the subsidiary, again increased supervision will involve increased agency cost in terms of time spent by Arthorou Company management. So, B Company management may feel that the new policy threatens their remuneration, as the limited funds available for investments will adversely affect the company's ability to maintain profits. The managers may seek to join competitors, disrupting B Company's management, jeopardizing its ability to achieve its profit forecast. So now what is happening? You know that the parent company, they are in the way that the subsidiary should remit 96% of its profit after tax. So they will be overseeing that how the management efficiently working. But this will be giving the subsidiary management a demoralize them. They will be feeling like this, that somebody is watching them, somebody is noticing them. They will be not free. They will be not working in a good practice, in a good mind, because they are now having the mind that someone is disturbing them. It is restricting their autonomy. So this is creating the agency issues. Agency issues are when you are not working for yourself and you are creating the problem for the others. So how you are resolving them? Way of motivating the B company management, including making their remuneration less dependent on B company results. For example, allowing them share options. If more of their remuneration depends upon the group results, B company management may be happier with the suggested arrangement if they feel it will benefit the group. However, this motivational effect will be limited if B company management feel that the group results are not influenced much by what they do. So means if now we are trying to give them some motivation, like uh, you can give them any share option schemes. You can say them means say that as they have little funds for the investments, so they are demoralized. But just have a table talk with them that the investment which you are sending, we have to pay the shareholders the dividend. We have to utilize this investment in our future investment projects. Have a table talk with them. Alternatively, a greater proportion of B management remuneration could be by methods which are not dependent on its result. For example, increase their salary or better benefit. However, by weakening the link between results and remuneration, it lessens their incentive to strive to produce the results needed to maintain the required level of the dividend. So the decision making on investments at group level may have to change. B company will under the new policy have insufficient funds for major investments. Its management team should have the opportunity to make a case for retaining a greater percentage, as they may have better investment opportunities than those available to the parent. So in the result, you should say that instead of having this policy, we should change the policy so that there will be some investment left for the subsidiary company as well, and the subsidiary will be more happy instead of having the arrangement which is going to be there now. So that is a very, which is a challenging scenario that one party is struggling and the other party is taking the major portion of the benefit. That is a very demoralizing thing. This should be resolved on the urgent basis. So I think so that was a good question as part of the theory as well as the numerical portion.